Bismillahirrahmanirrahim. In the previous class, we discussed about cash flow statement. In that, we discussed about the first part of the cash flow statement, that was operating activities. Today, we are going to discuss the second part, and that is investing activities. In investing activities, basically all those things that company is purchasing for use it in the operations of the business, like purchase of land, purchase of building, machinery, and these things. And investment in bonds and shares, if a company is making investment, if they have excess cash and they are investing that money in bonds and shares of other companies, or they are purchasing treasury bills, or they are purchasing commercial papers, these type of activities, these are coming in investing activities. So see, in an investing activity, cash flow from investing activities includes the movement in cash flow as a result of the purchase and sale of assets, purchase and sales of assets, other than those which the entity primarily trades. We are not talking about inventory. Except inventory, all assets, all other assets except inventory, the purchase and sales of other assets except inventory, it is coming in investing activities. Now keep in mind one thing, we are talking about the movement of cash flow from investing activities. So the increase in cash or decrease in cash because of the purchase and sale of asset. When you will purchase assets, you're paying money, so cash is going out. When you're selling asset, cash is coming to the business, so that is cash inflow. So cash is increasing, but we are not talking about inventory. So for example, in case of manufacturer of cars, proceeds from the sale of factory plant shall be classified as cash flow from investing activity. Now suppose there is a company that is manufacturing cars, vehicles. Now, if there is a sale by selling plant of that manufacturing company, that car manufacturing company, if they are selling their plant, so that is coming in investing activities. But if they are selling cars, that is not coming in investing activity because it is their operating activity. Purchase, because it is a car manufacturer, so their inventory is basically cars. So the purchase of plant and machinery and sale of plant machinery, that will come in investing activities, and the sales of car, it will come in operating activities. Whereas the cash inflow from the sale of cars shall be presented under the operating activities. So we talk about two things. Now see, in investing activities, we are talking about purchase and sales of assets. except machinery. Machinery will, except inventory. Inventory is not coming in this. I told you about inventory. Inventory, purchase and sale of inventory, it is operating activity. We discussed it in the previous class. So, in investing activities, investing and ACI shortly write for activities. Purchase and sale of assets except inventory. Inventory is not coming in this. So if there is a car manufacturing company, a company which is manufacturing cars, so the sale of car, it is not investing activity. If cash is coming from the sales of car, so it will be operating activity. But if they are selling their plant and machinery, now that thing will come in investing activity. Now, cash flow from investing activities consists primarily of the following. Now see, cash outflow expended on the purchase of investment and fixed assets. Now I told you about investment. If you are purchasing bonds, you are purchasing shares, treasury bills, etc. So these are investments of the company. If you are purchasing these investments, so there will be a cash outflow. But if you are selling these investments, so there will be a cash inflow and fixed assets, except, I told you, inventory. But fixed assets, so it is clear, simply. Land, building, machinery, furniture, these things. Then the second thing is cash inflow from income from investments. Now, another thing is if there is an income on the investment, like you purchase bonds, so on bonds you receive interest. So that interest will come here in investment activities. And if there is a dividend, so that dividend will also come in this investing activity. Means cash is coming into the business from those investments. Cash inflow from disposal of investments and fixed assets. We already discussed about this. If you are selling your fixed assets or you are selling your investments, so there will be a cash inflow. So that is also coming in investing activities. So three main things, just you can say two main things: cash outflow and cash inflow from the purchase and sale of investments and fixed assets. If you are purchasing investments, so there will be a cash outflow. If you are purchasing fixed assets, there will be a cash outflow. But when you are selling investments or fixed assets, so there will be a cash inflow. And the second thing is cash inflow from income from investments. And if there is an investment, you made investment in a company, suppose this is your company, you have excess cash. Now you invest it in bonds and shares of other companies. So now from the purchase of these bonds and shares, on bonds you are receiving interest. So that interest is an income. There will be a cash inflow. And if you purchase shares, so there will be dividend. The company will receive dividend. So that will be an investing activity. If cash is coming from these investments, interest or dividend, so cash is coming to the business, so that will be an investing activity. Now the last component of the cash flow statement, it is financing activities. Now in financing activities, cash flow from financing activities includes the movement in cash flow resulting from the following. The first, proceeds from the issuance of share capital, debentures and bank loans. Now we are talking about financing, the sources of income. This is company. Now in financing, we want to generate cash. Now the first source is, suppose the company took a bank loan. We took a loan from a bank, so cash is coming into the business. So that is cash inflow. There is a movement of cash towards the company. But when you are repaying loan, so again cash is going out of the business. So there will be cash outflow. There is cash inflow when the company is taking loan, when the company is applying for loan. When company is applying for loan, so cash is moving in this direction towards the company. But when after the completion of the time period, now company will repay loan. When the company will repay loan, there will be a cash outflow. Company will repay the loan to the bank. One thing. Now, if the company is issuing debentures or bonds, this is company, they need finance, so they are issuing bonds. Suppose this is a bond, its face value is $1,000. The company is paying 8% interest, and its maturity is suppose 5 years. So they are issuing bonds because they are in need of money. Now public, people, different financial institutions, companies, they will purchase the bonds of this company. When they will purchase bonds, so bonds will go to the public, cash will come to the company. Bond is going in the hands of the public, and $1,000 for one purchase of bond, for the purchase of one bond, there will be cash inflow to the company. But when company will repay after 5 years at the maturity of the bond, now company will repay this money back to the public. So now in that case, there will be a cash outflow. And that cash outflow, it will be now in this direction. Company will take the bonds back and will repay the cash to the public. So there will be a cash outflow, CO. Same is the case of shares. When company issues shares, so shares will go to the public, and money will come to the company. Suppose the price of one share is $10. So $10 will come to the company for selling one share. Companies are issuing thousands of bonds to the public. So here he's talking about this thing. Proceed from issuance of share capital, issuing shares, debentures. Debenture is a type of bond, and bank loans. So money is coming to the business. Cash outflow expended on the cost of finance. Now, one thing, when you issue shares, you issue bonds, you take a bank loan. So in all these cases, there is a cost of finance. That is, on shares, you will pay dividends to the public. On loans, you will pay interest to the public. So cash is going outflow. So there will be a cash outflow. That is also coming in financing activities. And the third thing is cash outflow on the repurchase of share capital and debenture of and repayment of debenture and loan. We discussed about this already, that when you will repay, when you will purchase the shares back from the public, then there will be a cash outflow. And when you will repay the loans and debenture, when you will repay the money of the loan and purchase and no and you will take the bonds back from the public, then in that case there will be a cash outflow. So these are basically financing activities. In financing activities, you are taking loans, so there will be a cash inflow. When you will repay the loan, there will be a cash outflow. When you will issue bonds, there will be a cash inflow. But when you will return bonds, you will take the bonds back and will repay the money to the bondholders, there will be a cash outflow. Same is the case in share capital. So these are three main activities, and the cost on these finances, when you will finance your business through loans, through debentures, through share capital, so in that case you will pay something to the bondholders, interest expense, or you will pay interest to the bank, and to the shareholders you will pay dividends, so there will be a cash outflow. Purpose and importance. What is the purpose and importance of cash flow? Statement of cash flow provides important insight about the liquidity and solvency of companies. It will give us a more detailed information about the liquidity and solvency of company. Liquidity, short-term debt paying ability, and solvency, you can say the long-term debt paying ability, which are vital for survival and growth of an organization. And you know, these two things are very important for the survival of organization and for the growth of organization. We'll discuss these things in ratio analysis. You already studied, but we will go in detail of these things. It also enables analysts to use the information about historic cash flows to form projections of future cash flows of an entity. Now, on the basis of the past cash flows of the company, you can predict about the future cash flows of the company. Here is one example, that is net present value, NPV. You already studied this NPV in financial management, on which to base their economic decisions. Then on the base of those projections, those forecasts, they are making their decisions. Then there is one more topic, that is supplementary notes to financial statements. We discussed about this. Includes explanations of various activities. We are not talking about now the cash flow statement. This is a separate topic. We call it disclosures. Includes explanation of various activities, additional detail on some accounts, and other items as mandatory by the applicable accounting framework such as GAAP and IFRS. GAAP is generally accepted accounting principles, and IFRS is International Financial Reporting Standards. Now, GAAP and IFRS, GAAP is used in USA and neighboring countries, and IFRS, it is used in UK. Now, they made an important decision. If something important happens in the business, so you will give detail of that thing below the statements. Like this is a balance sheet. Now in this balance sheet, some important event happens. Suppose you purchased a piece of land. Now because of this, there will be a bigger impact on cash, and there will be a big impact on fixed assets. Now you will explain this thing here in detail, why there is an increase in land, that much increase in land. So if some important events happens, you will explain these events one by one below the financial statements. We call it disclosure, and this is mandatory from the GAAP and IFRS. These are standards. So in financial reporting standards, IFRS and GAAP, it is mandatory that you will explain the important events that happens during the year in disclosures, in notes below the financial statements. We call it supplementary notes to the financial statements. Inshallah, about this cash flow statement, there will be a question in the next chapter. So maybe inshallah you will understand this cash flow statement in detail. I think for today it is enough. Inshallah, in the next class then we will talk about cash flow statement again in detail.